Welcome to StokTok's deep dive into Gilead Sciences Inc. Gilead is a biopharmaceutical company that discovers, develops, and commercializes medicines across infectious disease, oncology, and cell therapy, some of the highest-stakes therapeutic areas in global healthcare. At the time of recording, the stock is trading at 130.4 over the trailing 52 weeks. It has ranged from 95.3 on the low end to 157.29 on the high end, putting current price roughly in the middle of that range. The 50-day moving average sits at 142.34, while the 200-day average sits at 125.14, suggesting the stock is currently trading below its near-term moving average, but above its longer-term trend. The Relative Strength Index, or RSI, is at 30.8, which falls into a neutral zone, not yet signaling either oversold or overbought conditions. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Gilead Sciences generates revenue by discovering and selling branded pharmaceutical therapies, primarily in infectious disease, including treatments for HIV, hepatitis C, and hepatitis B, as well as in oncology and cell therapy. The company has built significant intangible assets, proprietary research platforms, and established commercial infrastructure across major markets, and regulatory-approved therapies that command pricing power and switching costs. The StokTok score on this name is 49 out of 100, signaling caution. Breaking that down, Valuation scores just 3 out of 20, which signals real concern on price. Financial health comes in at 16 out of 20, indicating a moderately solid foundation. Profitability is strong at 19 out of 20. Growth is very weak at 3 out of 20, which is the core worry, and smart money positioning scores 8 out of 20, suggesting institutional conviction is limited. Now, valuation. The question every investor has to answer: are you paying the right price? The price-to-earnings ratio, or P, is 20.33 times trailing 12 months earnings. The forward PE, which looks ahead to consensus next 12 months earnings, is 16.11 times. That forward multiple is actually reasonable for a healthcare company with this profitability profile. But the PEG ratio, which divides the PE by expected earnings growth rate, sits at 1.67. A PEG above 1.0 signals that growth is not keeping pace with valuation, which we will explore in more depth in the growth section. The enterprise value to EBITDA multiple, or EV/EBITDA, is 13.7 times. From a sector perspective, large-cap pharmaceutical companies have historically traded in the 12 to 18 times EV/EBITDA range, so this sits roughly in the middle of historical norms. However, the GuruFocus Value estimate, a blended intrinsic value model, comes in at 90.54, while the stock is currently trading at 130.4. That implies a margin of safety of negative 52.02%, meaning the market is pricing the stock at a significant premium to that value estimate. Wall Street analysts, at the time of recording, have a consensus mean price target of 158, with a high target of 180 and a low of 123 across 28 total analysts. That suggests a modest upside from current levels if the consensus plays out. The next earnings report is due May 7, 2026, with the street expecting earnings per share of approximately 1.91. Market sentiment around Gilead Sciences, as of the creation of this video, leans neutral. In our view, valuation presents a headwind. The stock is trading above intrinsic value estimates, growth does not justify the multiple, and there is little margin of safety for disappointment. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point financial health checklist that evaluates profitability trends, leverage, and liquidity, comes in at 8.0 out of 9. That is a very strong signal. It indicates that balance sheet trends and operational efficiency metrics are moving in the right direction. Altman Z score, a bankruptcy risk model that combines profitability, liquidity, leverage, and market values, is 4.38, Any Z-score above 3 is considered in the safe zone, indicating very low bankruptcy risk. On the debt side, the company has a cash-to-debt ratio of 0.39, meaning cash on hand covers less than half of outstanding debt. That is not uncommon for a large, stable pharmaceutical business, but it is worth noting. Interest coverage, the operating income divided by interest expense, showing how many times the company can cover its debt service, comes in at 11.41 times. That is solid. The company is generating sufficient operating profit to comfortably service its debt obligation. The current ratio, which measures short-term liquidity by dividing current assets by current liabilities, is 1.55. A ratio above 1.0 is generally considered healthy, so this sits comfortably in the safe zone. The debt-to-equity ratio is 1.10, meaning the company is using leverage roughly in line with equity value. For a cash-generative pharma business, this is a reasonable capital structure. Overall verdict: the balance sheet is strong, credit metrics are solid, and financial stress is not a material concern. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, is 21.68%. That is exceptional. It means the company is generating nearly 22 cents of profit for every dollar of capital invested in the business, a hallmark of businesses with durable competitive advantages. The gross margin is 78.83%. For a pharmaceutical company, that is robust and reflects pricing power over the cost of goods sold. The operating margin is 39.74%, meaning that before interest, taxes, and other items, the company is converting nearly 40% of every revenue dollar into operating profit. That is extremely high and demonstrates the leverage in the business model. The net profit margin is 28.91%, indicating that after all expenses and taxes, the company retains nearly 29 cents of profit on each dollar of sales. The free cash flow margin, which shows operating cash generation after capital expenditures, is 32.12%. That is remarkable. It means the company is converting roughly a third of all revenue into cash that shareholders could theoretically claim. These margins are among the best in the healthcare sector and are the result of years of product development, market exclusivity, and operational discipline. The verdict here is unambiguous. Gilead is a high-margin, highly profitable business generating exceptional returns on capital. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is 2.60% annually. Over the trailing 5 years, it is 3.10% annually. Both of these are materially below historical inflation rates and the long-term growth rate of the broader economy. This is the core issue with Gilead Sciences. Despite exceptional profitability and financial strength, the top line is stalling. Book value growth over the trailing 3 years is 2.40%. That is also anemic. The dividend yield is 2.32%. For a low-growth pharma business, a 2+% yield is reasonable and reflects a mature company returning cash to shareholders through dividends. However, the fundamental problem remains. Revenue growth is struggling. In our view, this reflects several structural headwinds. First, key legacy products are facing patent expirations or have lost exclusivity in important markets. Second, hepatitis C treatments have become victims of their own success. Many patients have been cured, shrinking the addressable market. Third, new product launches have not yet offset losses in the legacy franchise. The market is essentially pricing this as a mature, slow-growth pharmaceutical company, and the data supports that characterization. This is why the PEG ratio of 1.67 signals concern. The valuation multiple is not justified by the anemic growth profile. One must ask whether a 2 to 3% grower deserves to trade at a 16 times forward PE multiple. In our view, it does not, absent acceleration in the pipeline. Now let's talk smart money. What institutional capital is actually doing with this name? 16 top-tier gurus and super investors currently hold this stock, according to Dataroma's tracking. However, the largest holders are taking a concerning posture. Dodge and Cox funds, which represents 1.74% of their portfolio, has been reducing their position, cutting holdings by 12.78% recently. Ariel Investments, representing 0.27% of their portfolio, is also reducing, cutting by 6.27%. This is meaningful. When prominent value-oriented investors start trimming positions in a stock, it often signals deteriorating conviction. Among the 13 F filings tracked, these are quarterly institutional holdings disclosures. Only 13.3% of filers are net buyers, meaning they hold more than half their positions in growth mode. That is well below the 50% threshold that would indicate broad institutional bullishness. Insider ownership is extremely low at 0.70%. Management and board members own almost no skin in the game, which is a yellow flag. More concerning is insider selling activity. Over the last 3 months, there have been 0 insider buys and 12 insider sells. That is a 10-to-1 ratio of selling versus buying, which is precisely the kind of signal that causes portfolio managers to raise their eyebrows. When insiders are net sellers, especially heavily, it suggests they lack conviction that current prices represent good value. The smart money signal here is clearly red. The combination of guru trimming, low institutional ownership, and heavy insider selling paints a picture of declining confidence among sophisticated investors. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at a meaningful premium to intrinsic value estimates, with a 16 times forward PE multiple that is not justified by a 2 to 3% growth profile. The margin of safety is deeply negative, leaving little room for disappointment. Financial strength. The balance sheet is solid, credit metrics are robust, and bankruptcy risk is negligible. This is a fortress balance sheet. Profitability. Gilead is exceptional, 21% return on invested capital, nearly 30% net margins, and 32% free cash flow margins. The business model is fundamentally sound and generates extraordinary returns on capital. Growth. Here is where the thesis breaks down. Revenue growth is 2 to 3% annually, book value growth is stalled, and the pipeline has not yet offset losses in legacy products. This is a mature, slow-growth pharmaceutical company, and that is reflected in investor sentiment. Smart money. Gurus are trimming, insiders are selling, and institutional ownership is concentrated among a narrowing set of believers. The cumulative positioning suggests declining conviction. In our view, Gilead Sciences presents a classic value trap, a profitable, well-managed business with a fortress balance sheet, but one facing genuine growth headwinds at a valuation that assumes better things ahead. The setup warrants caution. Investors might be attracted to the dividend yield and the profitability metrics, but they must reconcile those strengths against anemic growth, insider selling, and a valuation that offers little margin of safety. One might argue the case for owning Gilead if you believe the new pipeline will reignite growth, but the data does not yet support that thesis. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Gilead Sciences Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.